morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1Mby1M, as you know, is the first and only global virtual accelerator in the world for technology startups. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. In support of that mission, we do these free mentoring roundtables week after week after week and year after year after year. This is the 563rd session that we're about to launch into. And every single recording is available on our YouTube channel. This event is being recorded. The channel is 1M1M Roundtable. On Twitter, we're at 1M1M and at Stromana, hashtag 1M1M for today's live chat. And the audio bridge is on your screen. I will put this up later. We have scheduled programming first. We'll go through that, and then, of course, during that, please feel free to participate using the public chat and, weigh in, ask questions, etc. But these are the call-in instructions for later on in the program. We are going to speak today with Gans Subramanian, managing partner at Hourglass Venture Partners. And we've known Gans for a very long time. Gans has been part of the 1M program earlier on. He was just saying it was 2011 when he was part of the program. So it was right after we had launched. So welcome, Gans. It's great to see you. Looking forward to catching up.
Pleasure is mine, Shramana. Thanks for having me.
What is Hourglass Venture Partners? What are you doing? What's the investment thesis? Tell us more.
Yeah, our investment, Hourglass Venture Partners is probably a new kid in the block in the world of venture capital here in the valley. Probably we are maybe the millionth, as a figure of speech, venture fund. Our investment thesis is very simple. Find mission-driven founders and back them with the venture capital plus we call, which is just capital plus go-to-market help and access to customers. And thesis
what is the size of the fund, Gans?
It's a $50 million fund.
50 million. And what size checks are you writing?
We've written checks as small as $250,000. We go up to $2 million. So that our typical range is $500,000 to $2 million is what we started with $500,000 to $1 million, but as the fund size got bigger, so we decided to increase it. So.
And what stage? How do you define when a venture is ready for your investment? What are you looking for in the venture to start writing checks?
Yeah, so pre-seed to late seed or pre-series A, that's kind of the range. But typically this is how we looked at in the venture world, right? Which stage of the company. So given my experience as an entrepreneur and my partner, we look at where they are in the journey in their product market fit. Is there a roadmap to product market fit? So we look at that, and in almost all cases, there's an early traction or maybe early product fit. But so that's the stage we invest in. So we are seeing companies, founders raising capital in Series A, but there's no real product market fit as well, right? So it's just how many rounds they've raised. For us, we look at it as, is there a product market fit? We invest earlier than they found their true product market fit.
So let me synthesize what you said. You are willing to fund companies that have not yet found product market fit, but they have some customer interest and there is a roadmap to product market fit. That is the journey that you are funding.
Absolutely, absolutely. And just to add to that, in the pre-seed stage, they don't need to have necessarily a customer, but we don't look at that as a specific criteria to invest. Rather, what problem are they going after? The founder's clarity on the deep insights they have about the problem, and that could be in pre-seed, that could be seed, that could be pre-series A. So.
Okay, so what about geography? Where do you like to invest?
Predominantly US. We just made our first investment in Europe, and we made also an investment in India, but predominantly it's a US geography. But in the
All over
US,
the US or just
all over the
Silicon?
US, all
All
over
over
the
the US.
US. Yeah. Yeah.
Okay. And let's talk about what you like to invest in terms of sectors. B2B, B2C, enterprise, mid-market. What is the sweet spot of your fund?
Yeah, so sweet spot we will find out as we go through this. Our first year in existence, 2021, we launched B2B focused. Um, Mid-market to enterprise, the is how we look at, but the sectors. So we started with the thematic investment, right? We identified 7 themes, and for example, video is the new data, voice is the new user experience, no code moment, and things like that. But as we went through the first year, we made 10 investments in the year one, and but we categorize all of them, all those 7, 8 themes into 5 areas: fintech, crypto tech, health tech, and AI, ML tech, all around the digital transformation. And then the last one is the cyber tech. We have 1 or 2 companies in each of those categories. So that's how we look at. We don't want to be sector focused. We are just focused,
Yeah.
B2B focused. Yeah.
So double click down for us on some of your pre-seed investments.
Yeah.
And tell us more about what those companies are all about, and how did you meet them? In what stage, what state did you meet them? And what is it about those particular companies that compelled you to write those checks?
So almost all of our investments are inbound referrals from our LPs or other venture firms we work with. We have relationship with. Some of them looked at what used to be seed funds have now gotten bigger. So when they run into some of them, they look at some of these companies and say there's something interesting about this founder and this problem, but there are quite a few things have not been figured out. So that's one type of inbound deal flow for us. And second, from our LPs, our LP demography is all operators, executives, and we don't raise money from family offices uh, by design yet, in this fund at least. So that's our deal flow and kind of companies. But the stage is that, like I said, we look at for founders, ideas get into the conversation. There are a lot of ideas, obviously, right? What is the founder's insights about the problem, why they are best suited to invest? I mean, to go after that problem is what gets us going, and how they think about it, and are they coachable founders? Predominantly product founders, not the usual, the sales founders, right? The product founders who have deeper insights about the problem, but their thinking around go-to-market is not quite well thought out or fleshed out yet. So where they could take some help from us, and we built go-to-market channels, which we bring them for them to evaluate, validate. So for us, more than the check marks or the tick marks we look for, other the clarity of the problem, and do they have a path to get your 1 million, right? $1 million in revenue run rate in 18 months to 24 months. And what all?
So
Yeah.
let me synthesize what you said. First and foremost is the product founder, not a sales founder or a business founder. You need a technical founder solving a problem that they have deep insights about. That's who you want to invest in. A pre-seed investment is largely investing in the founder.
That's correct.
So founder with a particular insight about a problem, and then you want to see a path of how that problem gets translated into products and go-to-market fit within an 18-month period leading up to $1 million revenue.
That's correct.
That's the synthesis. Okay, let's do some examples, maybe 2 or 3 examples of what you have invested in that fit this bill.
Sure. So we invested in a company called CapConnect, that's actually first check we wrote. Great team. They actually, they have not built a product, but all the founders have deep insights about the problem they're solving. I think they had the first mover advantage. So they've, so CapConnect Plus is a company which is building what do you call so we call them how do we say that? Robin Hood for corporate bonds. So 3 founders who raise corporate bonds for large enterprises before us, CFOs and treasurers. They said this is the way this is done is pretty much the last 30 years hasn't changed, and there got to be a better way to do this. And they wanted to go build a platform to democratize this. And they did not have even a strong technical founder along. So we saw the clarity the founders had, and they had the risk for them was to get their license, dealer broker license, and we invested, and then since then they built a great team, great company. So this is one.
So you didn't invest in a product founder in this case. What you started off by saying is you only invest in product founders, but this is not a product founder that you invested in.
This is a product founder. To me, it's not when they say product founder, do they have a clarity of the problem they want to solve? Building product is later, right? What product they want to build to solve the problem is when they use that word product founder.
I see. So you're saying that in this case, what you invested is in the product manager who had a good understanding of the product that was going to be built, but not necessarily the mechanics of implementing that solution.
That's correct.
Okay, got it.
Because
your definition of product founder does not necessarily correlate with the technical founder.
Absolutely.
Got it. Okay. Let's do another couple of examples. Just want to, illustrate what you're saying with some more visceral understanding so that people can grasp what you are saying. In pre-seed is a very interesting stage of investment, and it is probably the least liquidity stage of investment. There aren't that many pre-seed funds, and there are not that many people who are willing to invest in first-time pre-seed founders. So that's why I want to probe deeper into what is fundable and what is not fundable.
Yeah, so, I mean, the fundability goes with, you know it, and all the founders know it's large enough a problem, and et cetera, right? That's the kind of fundability problem. But the particular founders to back is all about founders, all the things we talked about. There's another company, probably it doesn't work. So in that stage, pre-seed, probably, there are a couple we are in the process of investing. One is a founder in the cybersecurity space, for 20 years in cybersecurity. When this whole software supply chain issues, the SolarWinds attack happened. So this founders came up with this idea. They have not built a product. They're probably in their 8 weeks of existence. This is sort of incubating even in the company, sort of, right? Because the founders have a clear view of the problem, and they are technical founders, but first and foremost, do they have a clear view of the problem, and they have a path to go build a great company? They have a path to go get $100 million in revenue run rate in $100 million company in the 24 to 36 months, and assemble a great team. So this is again a pre-seed stage, even in a very early idea, but the founder has been thinking about this and talking to us for the last 6 months, and even before they formally launched it, right? So this is a product /
So weigh in a little bit on cybersecurity entrepreneurship and investment. It has become very, very difficult to sell new cybersecurity products and get meetings even with CISOs or CIOs. And a lot of early stage VCs who are investing in cybersecurity right now are investing with the kind of build to some extent, get some validation, but then basically exit. So there's a lot of conversations happening in the cybersecurity investment world that is not looking to build $100 million in, you said $100 million in 24 to 36 months. I think that's an absurd idea.
No,
I think it happens in cybersecurity.
Value creation, right? I mean, you can get $100 million if you get to $5 million in revenue, right?
$5 million in valuation, not revenue.
No, $5 million in revenue, so you get to, they see a path to $100 million in value in the next 36 months.
Okay, so you are thinking the same way. You're thinking about building capital efficiently and getting to about $5 million in revenue in the 36 months, and then exiting into a sizable cybersecurity company.
Yeah, so it's interesting you asked this question. Like we don't want to think about the exit by design for now, right? The early days, many
you have
things
to think about the exit. We are in 2022. This comment that we don't want to think about exit, I think, is a flawed statement, Gans, because at this point, especially in cybersecurity, you have to think about exit.
No, those outcomes is going to happen, but you don't, when you start off thinking about that and build for an investor, Shramana, that's how we believe, right? These
I think
opportunities
it's
are
not belief, it's no longer contemporary. That belief was okay when we were in 2000 and the market was a lot less crowded. Today, that belief doesn't work anymore. You have to think through exit strategy. Are you going to build with a small amount of capital for exit, or are you going to build, swing for the fences and try to build a unicorn? These are two completely different strategies.
I agree, but we want to, so our thesis is this, right? When we invest in Series B in 36 months, right? Seed to Series B is 36 months. And 2 rounds of capital in 36 months. If they can find problem, they can solve, they can build a great product and revenue. All options are on the table, right? But from the get-go, okay, we're going to build this they will get acquired. That doesn't happen either. So all going for the fence is not our strategy, but we don't want to think about with that in mind because you can't control that anyways. So focus on the execution, help them build great company. If they find an exit, that's great.
That's why it matters.
What is that?
It matters because, where you invest, are you building for a full scalable channel, or are you building basically a product, a founder-led sales strategy where you get, some number of customers to validate that this product works and get the attention of the acquirers and you sell out? Because, building a channel is expensive. And is that where you're going to put in some of that early, very scarce amount of money that you're raising as a founder? I think these are vital decisions. You'll find out. You're just starting being a VC. You'll find out. These are all going to be concerns that you're going to have to think through.
We think about all these things, but we also believe that the companies get acquired, get sold. Get bought, not sold. So
those are cliches, Gans. Those are cliches. Those are no longer true. I think people are being very deliberate about exactly where they're going to go with things.
Absolutely, yeah.
Okay, very good. So, but what I'm very, happy to hear is that you are looking at pre-seed, because I think the gap in the market, in the venture market, is in pre-seed. So I think you're absolutely right in identifying that, that is the place to play. It is also the highest risk part of the investment cycle, because there is very little by way of proof points and so forth. So, it's a tough part of venture capital. But before this, huge fragmentation, segmentation that has happened in the venture business, before it used to be seed and Series A, and the seed investors or even Series A investors were doing what today's pre-seed investors are doing. Today's pre-seed, seed,
Yep.
post-seed, pre-Series A, small Series A, large Series A. There is this whole continuum, and there are different venture funds positioning against each of these different, rungs of the ladder. But that was not the case when venture capital started. Venture capital in its more immature state in the 90s and the early 2000s, even in the late 2000s. It was still, VCs, really regular VCs, had to do what Gans is talking about doing. They had to pick very early stage fund founders. Now the game has changed. The game has also changed to an extent because the founders are bootstrapping a lot more.
Yep.
So Gans, you're very familiar with the bootstrapping way of business building. So tell me a bit about what your perspective is on founders that come to you that have bootstrapped up to a point. How are you evaluating them, and what are you looking for from those situations?
So like I said, where they are and what journey they've taken is important. Actually, it's kind of a coincidence that you bring up this particular type of an opportunity. We are actually just made an investment in a company that bootstrapped for literally bootstrapped. They raised small amount of capital a long time ago. They bootstrapped, but they're at $2 million revenue run rate. Their challenge is not there's a lot of customers, but when entrepreneurs are in the market for a long time, many investors look at this, maybe there's a fatigue, like there's something didn't work out, right? But we look at like where the inflection point took off, and from that, what can help we can bring. Bootstrapping is great. Just that during the bootstrap phase and what kind of patterns they've seen, what they've understood, what works, what doesn't. Those are things we look for. And is there an opportunity to go help them accelerate what they found and double down on it, right? So those are things we look for. So even in this case, all the more in a bootstrapped case, it's scenarios. The founders is what we back, and if the founders, if we can back them with a good team and help them build a great team, and they can accelerate. It's about our view of what the market is. So we just made.
I think you're absolutely right. There is a bias against bootstrap companies that have been going for a while. But you're absolutely right that sometimes it takes a while to find that inflection point. There's product market fit, but there's also timing, right? So sometimes, the market is not quite ready. Maybe the founders have anticipated something earlier than the market was ready for it, and the inflection point comes later on in the continuum. So I think you're right that there are opportunities to invest in such companies where there's been a long bootstrapping phase, but the inflection point is now coming, and it is ready to take off in a bigger way. Very good. Great analysis.
I wanted to add to that. So the two things we look for an invest in a company, whether the bootstrap they've been enough for a long time or a pre-seed stage, deeper insights about the problem, and then the problem they're going after, that ecosystem space is at the point of inflection. That's what we look for. So that gives us an opportunity to, and when people, the founders have been around and they bootstrap for a long period, they really figure out, I've tried all these experiments, now this works, but now if it is a market of few, that's hard, but if there is enough sizable market to be created, then we back them, and we'd love to talk to bootstrap founders. So if you have somebody, send it to us. So.
Okay, I'm sure. Very good. Very good. This is an excellent discussion. Folks, you're getting a good, nuanced perspective, and it's very comfortable for me to talk with Gans because, he knows the 1M by 1M methodology. He has used it and so on. So we have the vocabulary that we can kind of work with in diving down into the details of how pre-seed funding happens and all these nuances of bootstrapping and so forth. So very good, Gans. Thank you. Okay. Now, if you like what we do here, folks, please let serious entrepreneurs know about 1 million by 1 million. The word serious is in bold, right? It's in all caps. And this is a very important point because we can only work with people who are willing to do the heavy lifting to build a business. There are entrepreneurs who are kind of not really willing. They have a magical kind of fantasy idea about business and about how to build a business. That's not who we succeed with. We are very thorough, very rigorous. The platform has a lot of learning abilities. You can start as quickly in your journey as possible on the 1 million by 1 million platform. You can learn, there's a curriculum and everything, but you have to have a mental set of working on your venture and working really hard. Entrepreneurship is very hard, and you're going to have to put in the work. In terms of resources, everything is on 1Mby1M.com. You can start with the blog, which is free and it's very rich. The Entrepreneur Journeys book series is a good starting point also for your learning. These roundtables happen every week. You're welcome to come back as many times as you want. You can pitch at a free roundtable only once, but if you're in the premium program, these roundtables happen every week and you can come back every week, no problem. I'll come back and discuss every week. The premium program offers you extensive methodology guidance. We have the curriculum included in the premium membership. We help you with business development where we have contacts. We have an extensive Rolodex. You're welcome to that Rolodex. We do the strategy consulting, this interactive project-based work in similar roundtables, but they're private and premium members only. And then we help you with financing, and we have a lot of clout in the media, so we help you with media relations as well. So that's the premium program. The self-assessment on our website is a good tool for you to test your venture against what kinds of questions VCs ask you. So use this and see where you are, calibrate where you are. The bootstrapping course on the website, on the blog, is a free, less than 1 hour course. We are big proponents of bootstrapping, and the philosophy is very clearly articulated in a less than 1 hour course. We've also released a lot of courses on Udemy at this point. In the last less than 12 months, we started releasing courses on Udemy. It's part of our democratization of entrepreneurship education strategy, and Udemy has a very large user base, and we're bringing our material to that audience as well. So you'll find, if you look for Udemy courses based on the 1M1M methodology, you'll find all of them. If you get stuck, let's say you're doing the self-assessment, and you get stuck on specific methodology points, let's say bottom-up TAM analysis is not something you know anything about. The easiest way to plug your knowledge gap is to go do 1M1M Basic, which is our curriculum-only option, and you can study the modules that you want to, plug gaps, knowledge gaps in. In general, though, the core curriculum in 1M1M Basic is tailored for early stage first-time entrepreneurs to learn all the building blocks of how to build a venture. So if you do one, chunk of learning, a good solid 50 to 100 hours of learning on 1M1M Basic is going to immeasurably put you in a better position. So go to the website, dig around what to expect from Basic, what to expect from Premium. There are FAQs, video FAQs. The curriculum is described in great detail. We are a case study-based curriculum. So everything happens in case studies. Every single piece of methodology we have put in place in our curriculum, in the methodology guidance that we provide is backed up with extensive case studies. And all the people who are part of that case study program are part of our network, and if there's need to or if there's reason to, we make those connections. Investor Introductions has a policy just by joining premium membership, you're not going to get introduced to investors. You have to be a premium member to be introduced to investors, but you have to be more than that. You have to be a premium member, and you have to become fundable by our judgment. And that requires, all the pieces that we need to be able to send you to investors, and then investors engaging with you in meaningful, serious ways. So we don't want to introduce you to 37 investors and you get 37 rejections. That's not helpful. That is not a good way to run an accelerator. Our methodology is bootstrap first, raise money later. Do not go to investors as beggars, go as kings is the mantra. And we use lean, capital efficient bootstrap startups to achieve that kind of success, such that when you do go out to raise money, you have, great traction. So that is all. We have 2 roundtables in February, and then March is going to be more or less chock full. I think there's 1 week that Maureen is off, that we don't have roundtables on, but otherwise we have roundtables every week, and you're welcome to come back as much as you want to. We're ready for Q&A. You're welcome to dial into the audio bridge, or you can also use your computer audio to ask questions. Questions about the program, Irina Patterson is your contact, irina@1Mby1M.com. Gil, as I'm going through this and I'm thinking about your pitch deck, there's one other area where I think you should spend some time is margins. Briefly I saw a slide that showed your margin was increasing. So tech VCs like high margin businesses. They don't like thin margin businesses. So that's one you should kind of blow out in terms of projections, is that we are already showing a trajectory of how the margin is improving, and this is where we expect to be in the next 3 years, 5 years kind of thing.
Good point. Thank you.
You're very welcome.
Very good point.
Any other questions? Questions, comments, introductions? This is a good networking session. You're welcome to introduce yourselves and tell us where you're joining from, how you found us, and what projects you're working on. We have a little bit of time before we adjourn. Gil, if you have anything else, please feel free to.
No, this is very, very valuable. Very good feedback. Taking that into account.
All right. Good luck. I'm sure you will be able to find what you need to find. It's just a matter of packaging things in a way that investors can absorb quickly and really key into what you want to present.
Yes. Yeah. It's all about telling the story. The execution is there. It's all about telling the story. So that's it. Well, good stuff.
All right. Great. Well, wonderful session. Nice to see you all, and look forward to seeing you again next week. Bye. Take care.
Thank you. Bye-bye. Bye-bye.
Bye.